Welcome to the Deep Dive. We're here, as always, to take that big stack of financial sources you've got, cut through all the noise, and really give you the focused insight you need. So today, we're digging into the recent market pullback. That feeling of caution that seems to have suddenly crept back into the conversation. Our goal here is to get past those simple headlines, the ones just screaming market volatility. We want to understand the specific things actually driving this dip. Because if you just read the news snippets, it kind of feels like one big event caused it all, right? But what we found looking through everything is, well, it's more complex. The market isn't really reacting to a single massive shock. It seems to be more of a perfect storm, maybe, a mix of caution, some necessary profit-taking, and these significant macro risks that have just sort of bubbled up.
And getting that clarity is really key for you, the listener. Because if you mistake, say, a correction for a total collapse, or maybe you focus too much on one CEO's warning, you miss the bigger picture, the actual mechanism behind this downturn. What we're seeing is this interplay between missing information on one hand and maybe some inflated valuations on the other. Understanding that, systemic overlap helps avoid that feeling of being overwhelmed by information. It gives you a clearer perspective on why people are pulling back right now.
Okay, right. Let's unpack that then. You have to start with the fog rolling in from Washington. I'm talking about the Federal Reserve and this government data vacuum. So point one on the macro front has got to be the Fed's, let's say, muted tone. Investors were really leaning in, weren't they? Hoping for a clear sign, a sort of guarantee that the rate hikes were done, cuts were coming soon. But Chair Powell and the others, they gave, basically zero guarantees.
Yeah, it was almost like a collective shrug from the Fed, just delivered very politely. And that lack of forward guidance, that's a problem. It really is, especially because inflation is still stubbornly sticky, particularly in services.
Right.
So when you have sticky inflation and a central bank that just won't commit to a path, the market gets stuck in this kind of policy limbo. It's agonizing. And that uncertainty, it forces investors to second guess everything, which, almost always leads to taking less risk.
And it's worse if the Fed keeps saying they're data dependent, but then there's, no data. Which brings us neatly to the second big macro headwind. That data vacuum from the U.S. federal government shutdown.
Oh, absolutely. This is textbook uncertainty leading to risk aversion. I mean, think about what's missing. Key economic indicators, the jobs report we rely on, retail sales figures from commerce, even some inflation snapshots, they're all delayed. These reports are like the lifeblood for investment decisions.
It's like you said before we started, like sending a scout team out and then the radio goes dead. You know something's happening, but you've got no fresh intel.
Precisely. So when investors can't get that fresh, factual information about jobs or consumer spending or manufacturing, what do? They default to the safest position. And historically, that's reducing exposure, maybe sitting on cash. The data vacuum doesn't automatically mean the economy is tanking.
No, of course not.
But it guarantees we don't know how healthy it is. And that lack of trust in the numbers, it just accelerates any pullback that might already be starting.
Okay, so this is where that macro policy fog starts to really affect market sentiment, especially when you look at valuations. Those huge gains we saw were driven by the Magnificent Seven, right? Everyone was talking about that.
Yeah.
Now, our sources are definitely pointing to some serious concerns about overvaluation, particularly in AI and high-growth tech.
Yeah, overheated is the word you keep hearing. And the issue isn't necessarily the growth itself. That's real in many cases. It's the price people were paying for that future growth. A lot of these AI-focused tech firms, they're trading at price-to-earnings ratios, PEs, that basically assume years, sometimes decades, of just perfect execution, like explosive growth, no competition.
Totally realistic sometimes.
Well, it requires everything to go right. So when those macro risks pop up, like the geopolitical stuff Jamie Dimon mentioned, or this risk of rates staying higher for longer, suddenly those far-off, super optimistic earnings, they look a lot riskier, less valuable today. That's why you hear talk about the potential tech bubble or maybe just a localized correction. It's a concern focused on those specific companies that were carrying the market,
And speaking of targeted concerns, we absolutely have to talk about Jamie Dimon, the Dimon effect, as some are calling it. You can't really ignore it when the CEO of JP Morgan comes out with such a stark public warning. But let me push back a little. Is this just Wall Street being dramatic? We hear warnings all the time. Why did this statement from Dimon seem to hit so hard? Why is it a key driver now?
That's a really fair question. And I think it's not just what he said, but how he framed it. And frankly, his credibility. Dimon didn't just point to high valuations in isolation. He connected it to this sort of dangerous trio of risks. Rising global conflicts, worries about U.S. fiscal debt, and the stretched valuations. It was the combination.
Right, the whole package.
Exactly. So when he explicitly mentions the possibility of a significant market correction, it kind of validates the fears that were already bubbling under the surface for a lot of traders. It acts as this high-profile nudge, almost permission, for big institutions who really respect his view to maybe start de-risking their portfolios preemptively. It signals the issues might be more structural, not just a blip.
Okay, so we've got sticky inflation, missing data, diamonds warnings adding to the jitters. But let's be real, some of this pressure is just mechanical, isn't it? Psychological. I mean, it's not all doom and gloom. Sometimes people just take their winnings off the table.
Absolutely. That's a crucial piece, the technical pullback itself. You mentioned the S&P 500 and the NASDAQ hitting those impressive record highs recently. Well, after a run like that, it's just natural. Gravity eventually kicks in. People see those gains on paper and decide it's time to make them real.
So that's what they mean by a technical or psychological pullback.
Pretty much. It's a totally normal part of the market cycle. After a sustained rally, smart investors, or even just regular traders, look to close out positions that have done well. They're locking in gains. They might sell a stock today not because they suddenly hate the company, but because, hey, they made good money, and maybe they think they can buy it back cheaper in a few weeks or months.
Like a breather.
Exactly. It's like a natural pressure valve. It stops things from getting too carried away, keeps that irrational exuberance in check. So yeah, sometimes the market dips simply because traders are, taking a well-deserved break after a good run.
But it definitely doesn't feel uniform across the board. While the big indices are down, if you peek under the surface,
Yeah.
we are seeing some very specific things dragging down individual stocks, right?
Yeah.
Especially in tech. Like Tesla seems to be getting hit. There's renewed scrutiny, that safety investigation into their full self-driving system, the FSD. That's a company-specific overhang.
That's a perfect example. It's a company-specific risk, but it gets amplified by the general market fear. In a roaring bull market, maybe investors shrug off an FSD investigation, think they'll sort it out. But in a cautious, risk-off mood like this, that same regulatory pressure suddenly looks like a major liability. It hits the stock price much harder.
Okay, but on the flip side, there are bright spots. It proves not everything is suffering. Delta Airlines, for instance, they reported strong results, talking about robust travel demand, and their stock is actually rallying.
Yeah, and that provides really important context. It shows the consumer isn't dead, they're still spending, at least on experiences. And it's a big but. Delta's good news, while welcome, probably isn't strong enough on its own to offset the weakness we're seeing across the massive tech sector, given those valuation concerns we talked about.
Fair point.
And one other quick sentiment indicator, look at gold. It's staying strong, isn't it? Not crashing. It's holding its value pretty well.
Ah, the safe haven.
Exactly. It reinforces gold's classic role as that hedge against general uncertainty. It confirms that big money is rotating some capital into safety.
Okay, let's pivot slightly. Let's talk about those less obvious technical signals, the moves happening in bonds and currencies that act as headwinds for company earnings. We saw the 10-year Treasury yield tick up a few basis points recently. Doesn't sound like much, but how does a small rise, say from 4.2% to 4.3%, actually become a headwind for stocks? What's the mechanism?
Yeah, it seems tiny, right? A few basis points. But it's powerful because of the math, the valuation math. Higher interest rates get plugged directly into the discount rate that analysts use to figure out the present value of a company's future earnings.
Okay.
Now, for a big, stable company that earns predictable profits today, the impact is pretty minimal. But for those high-growth tech companies, the AI darlings we mentioned, their value is almost entirely based on profits they hope to make, 5, 10, even more years down the line.
Right. It's all future potential.
Exactly. So when that discount rate goes up, even just a little bit, those distant future earnings become significantly less valuable right now. So a few basis points on the 10-year can actually cause a big price swing for those high-duration growth stocks.
That makes a lot of sense when you put it like that. We also saw the dollar strengthening. Now, intuitively, a strong dollar sounds good, right? Why does that actually put downward pressure on big U.S. stocks?
Yeah, it's counterintuitive for a lot of people, but it creates this kind of double whammy for any major U.S. company that makes a lot of money overseas. First, think about currency translation. When a multinational earns profits in, say, euros or yen, and then converts those back into stronger U.S. dollars for their financial reports, those foreign earnings are suddenly worth less.
Okay, the exchange rate eats into it.
Right. That hits the income statement directly. Second, a stronger dollar makes American products more expensive for buyers in other countries. That can potentially hurt their international sales volume. So, yeah, a strengthening dollar basically acts like a hidden tax on the foreign earnings of all those big multinational corporations listed on U.S. exchanges.
Gotcha. Okay, finally, let's touch on the technical indicator that really seems to confirm this pullback is widespread. Market breadth. All our sources are highlighting weak market breadth. Can you simplify that for our listener? What does weak market breadth actually tell us about this decline? Is it just Wall Street jargon?
No, not at all. It's maybe the most crucial health check for the market at a time like this. Market breadth basically just measures how many individual stocks are actually participating in a market move. So if the Dow Jones Index is up 100 points, is that because 90% of its stocks went up a little bit? Or is it just because three giant companies had a really good day and dragged the average up?
Ah, okay. Participation.
Exactly. So when we see weak market breadth, it means that even if the main indices like the S&P 500 only look like they're dipping slightly, the reality underneath is that more stocks, sometimes a lot more, are actually declining than are advancing.
So it's not just a few bad apples.
Precisely. That's the definitive warning sign that the problem is systemic. It tells you the negative sentiment isn't just confined to those few high-flying tech names we discussed or just a couple of laggards. It confirms that the caution is spreading out across multiple sectors, different sizes of companies. It's like the whole platoon is taking a step back, not just the soldiers on the very front line.
Okay, so wrapping this all up, what does this synthesis mean for us? We started out trying to decode this pullback, maybe looking for that one big smoking gun, but it really seems like a multi-stage threat, doesn't it? First, that macro uncertainty, the Fed being quiet, no reliable data coming out because of the shutdown. Second, those specific valuation fears focused on AI and tech, but maybe amplified by warnings like diamonds. And third, just the genuine technical stuff, that healthy profit-taking after record highs, plus those background headwinds from higher yields and a stronger dollar.
Yeah, I think the final synthesis is that this pullback feels particularly cautious because all those elements are feeding off each other. Sticky inflation makes the Fed pause. The lack of data makes traders assume the worst. And that caution naturally hits the growth stocks hardest because they're the most sensitive to changes in those discount rates we talked about. It's really a chain reaction, a series of interlocking risks. And that's what makes this feel perhaps a bit more significant than just a typical garden variety dip.
Which brings us to our final thought for you, the listener, to chew on as you process all this. Given that strong evidence of weak market breadth, suggesting this decline is pretty systemic and widespread, how might the continued delay in getting key economic data, from the government shutdown, how might that be temporarily hiding the true, perhaps broader, and maybe more concerning nature of this pullback right now? Something worth mulling over next time you see a market headline.
Definitely something to think about, that connection between breadth and missing data.
We'll leave you with that thought. Catch you on the next deep dive.